For decades, the global economy has followed a familiar pattern: growth, slowdown, recession, recovery, boom and bust. Central banks would cut rates to restart growth, inflation would cool, and the cycle would begin again. But according to BlackRock, the world's largest asset manager, that playbook no longer works. The global economy, they say, has changed forever, and we're now living in a completely new era of growth, inflation, and policy. This isn't just another market outlook. BlackRock is saying the quiet part out loud, that the old economic order has broken down. The rules that governed money, trade, and investment for the past 30 years no longer apply. So, what's really changed? BlackRock's message is clear. We've entered what it calls a new regime. It's not a temporary cycle or a passing trend. It's a structural shift. The forces shaping the economy today are different, deeper, and more permanent than the ones that defined the post-2008 era. Let's break it down. For nearly 15 years after the financial crisis, the global economy was defined by three constants: low inflation, low interest rates, and easy money. Central banks flooded markets with liquidity. Borrowing was cheap, and investors could rely on steady growth. It was an era of predictable prosperity, where even downturns felt manageable. That era ended abruptly after the pandemic. When COVID-19 hit, governments and central banks unleashed record stimulus. Supply chains collapsed, consumer demand surged, and inflation roared back to life. Central banks tried to rein it in, but something fundamental shifted. Inflation didn't behave the way it used to. Even after rate hikes, it refused to fall to the old 2% target. That's the first thing BlackRock points out. Inflation is no longer a temporary spike. It's structural. It's being driven not by short-term demand, but by long-term forces: aging populations, supply chain fragmentation, energy transition costs, and a new era of government spending. All of these are pushing prices higher, not for months, but for years. The second change is the end of cheap money. For decades, central banks could cut rates to fight recessions. That safety net is gone. Interest rates are higher, and they're staying higher for longer. That's because lowering rates too quickly now risks reigniting inflation. BlackRock calls this the era of constraint. It means policymakers can no longer rely on stimulus to fix every slowdown. In fact, they may have to accept weaker growth to keep inflation under control. For investors and businesses, that's a huge shift. The days of free money, booming valuations, and endless credit are over. The new normal is tighter, slower, and more selective. The third change is the return of big government. After decades of globalization and privatization, governments are stepping back into the economy in ways we haven't seen since the 1970s. The US is spending billions on the CHIPS Act, green energy, and infrastructure. Europe is funding massive industrial policies. China is doubling down on self-reliance. BlackRock calls this state-directed capitalism. Governments aren't just regulating markets anymore, they're steering them. They're deciding which industries get support, which technologies get subsidies, and which countries get access to supply chains. This shift means global trade is becoming more political. The US, China, and Europe are all building their own spheres of production for chips, batteries, energy, and defense. That fragmentation raises costs, reduces efficiency, and keeps inflation sticky. The fourth change is demographics. For years, the global workforce was expanding, keeping wages low and productivity steady. But now, populations in developed countries are aging rapidly. Retirements are outpacing new workers, shrinking the labor supply. That gives workers more power and wages more momentum. Wage growth is now one of the main forces keeping inflation alive. Companies have to pay more to attract talent, and those costs get passed on to consumers. All of these shifts, demographics, deglobalization, energy transition, and government intervention, are creating a new kind of economy, one where inflation stays higher, growth stays lower, and volatility becomes the norm. In the old world, central banks controlled the rhythm of expansion and recession. In the new one, they're losing that control. BlackRock argues that this is the key difference. We're moving from a market-driven cycle to a policy-driven system, where fiscal spending, trade policy, and geopolitics determine growth more than interest rates ever could. So what does that mean for investors, businesses, and everyday people? For investors, it means the easy money era is over. Bonds aren't as safe as they used to be, and stocks will rise and fall with far more volatility. The new winners won't be the high-growth tech companies that thrived on cheap borrowing. They'll be the firms tied to real assets: energy, infrastructure, commodities, and defense. For businesses, it means the cost of capital, the cost of borrowing, expanding, and innovating will stay high. Companies will have to be more disciplined, more profitable, and more resilient. Growth for growth's sake won't cut it anymore. And for consumers, it means the world is entering a period of permanent tension between inflation and affordability. Prices won't skyrocket, but they also won't fall the way they used to. The economy will feel tight, even when it's growing. The takeaway from BlackRock's warning is simple but profound. The global economy isn't broken. It's adapting. The systems we built over the past 40 years, from global supply chains to monetary policy, were designed for stability and abundance. But the world has changed. Energy, demographics, and geopolitics are forcing a new order where resilience matters more than efficiency. In other words, we've moved beyond boom and bust into an age of permanent adjustment. The old playbook, cut rates, print money, wait for recovery, doesn't work anymore.